Hi, everybody. Welcome to another episode here of CRESI's Ontario Landlord Series podcast, where we are here to educate and inform landlords that have rental properties here in the province of Ontario. And today we are going to take this back a little bit, and we're going to talk to how to really get started. We've been doing this podcast for a while, and we're helping landlords out in all different aspects. But today we're going to circle back and really start talking about what to do at the beginning again, how to set things up, how to get started from your accounting point of view and with the financial side. So today we're joined by a friend and colleague here, Michael Matthew, who is a CPA and CA with 35 plus years experience. He is also a real estate investor himself, and he specializes in helping real estate investors. One thing that I've said before, we got to be getting advice from the people who are actually doing it themselves. To have an accountant help you do your books that doesn't have a rental property will probably miss some of the deductions and things that you should be looking for. So we're going to cover some of that stuff today. Michael also helps investors with both Canadian and American properties. He is the author of a book called A to Zen Real Estate, which is also geared towards helping investors get started. Whoa, that's a mouthful, right? And then lastly, he helps with the tax consulting for his clients, the structure, and also tax returns. So without further ado, Michael, welcome, say hi, and thanks for joining us today.
Thanks for having me, Kevin. Great to be here.
So I'm going to put you right on the spot here, and let's get started out with, I'm a brand new investor myself. With the market that's going on right now, we're playing an avatar game. I think it's a great time for me to buy something. What should I be doing? How should I set myself up? What would you give me as advice here as I'm getting started?
Well, to quote my lawyer's favorite response, it depends. And it really does depend on your situation. For some people, it makes sense for them to set themselves up in a corporation. For other people, it makes sense not to. And you really need to talk to a professional advisor that can help walk you through those distinctions, because the last thing you want to do is just talk to your neighbor and find out how he did it, because you have no idea what his situation is. And what works very well for him could be disastrous for you.
That is definitely bang on. And like we always say, right, we have to think about personalized, specific information and guidance. But for the purpose of this episode, as Michael and I are discussing this, we're going to talk in generalities. We're going to give advice out there that is general, not specific. So definitely get specific advice for yourself when you're starting to do this. Just like with everything, we are as individuals, our fingerprints, our situations, and everything differ, and that can matter so many different ways. So, on a general level, I'm here. I'm the regular person. I make about $100,000 a year. My wife makes about the same, so household income just over 200,000. Let's say something like that. And we're looking to buy our first investment property. What would you talk to us about?
You want to consider what works best for your situation. And if you set yourself up in a corporation, you get legal liability protection. That's one of the major reasons for doing so. However, what people don't always realize is that in Ontario, if you have long-term rental income into your corporation, you're automatically taxed at 50% plus from dollar one. And if you were to hold that same property personally, you'd have to make over $248,000 to be taxed at a rate as high as 50 plus percent. In fact, the rates started at about 20. So you really need to look at what's your situation. That said, if you were to invest in perhaps a small apartment building, perhaps 10 units, every person has at least one idiot friend. And so if you have 10 tenants, you now have 10 idiot friends visiting, and one of them's going to decide to do something crazy like jump off the roof because there's a big snowbank outside. There may or may not have been alcohol involved in that decision. And at that point, you're going to want the protection of a corporation, because otherwise, all your personal assets, your house, your car, any valuable possessions like art, jewelry, all that is up for grabs in a lawsuit. because as much as you need insurance and everyone has to have insurance, insurance doesn't always cover everything. There are limits, there are exclusions, and you can't rely on that as an absolute protection. Thankfully, we're not as litigious as our friends to the south, where to me, there's no discussion. Unless you're flipping a property, you're going to need to have some sort of corporate structure to protect yourself.
Yeah, normally when we're talking about it, just again, generally when I get asked that question, getting started, a lot of people tend to do that after they have a few different properties and they're starting to get more into the game with their first one. Normally they're just owning it personally, running it in with their um, annual finances themselves, annual income, right, to be taxed in that bracket as well, where they're looking at different things. But it's still their own, their liability, and there are ties to having that when it's under their own name versus the personal. But it's seems to be the risk, right? Where risk reward when we're thinking about also cost analysis, does it make sense to bring in all the extra cost to have an incorporation look after it as well with just one little condo or something like that that a lot of people have? It's from what I've seen, most people are multiple properties. Five, I'd say, are bigger people that I know that have it in a corp. Two, actually, one client of ours.
Yeah, cost benefit is absolutely the key. I like to think that everything I do for my clients is run through that lens of cost benefit. And you're right, most people start out with owning the property personally. And if it's in Canada, that can work out perfectly well. You do have the ability to then claim additional expenses that can give you perhaps in an ideal scenario, positive cash flow, but no tax to pay. And that's because of what's called CCA, which is capital cost allowance. And that's the tax term for depreciation. And what this allows you to do is to write off after the first year 4% of the cost of your rental property, which then reduces your rental income. And that may be a good move for you. Again, it depends on your situation. We've actually seen in high value areas such as Toronto and Vancouver, where there's a lot of appreciation, that you actually don't want to take that depreciation because it comes back when you sell the property as taxable income. So
Yeah,
just back to that initial thing I said of it depends. uh, You really need to discuss with your professional advisor what your goals are and what your situation is to get the best possible advice.
definitely, right? Everything is different. My sister has a property in Windsor, and I know that she records everything like gas travel and stuff like that as well when she goes down there, just so that she's thinking about the different things. What she can write off tax related, right? Her business expenses, I guess, to be able to be a deduction. So travel time and different things like that. There's monies that we should be able to write off, right? I say all the time to people, our property management company is a business expense and things that people should have as an expense, one, so they don't have to worry about the day to day and the nuances, so they can have their peace of mind. But they can also have that as an expense to go against their income, what they're making as well towards it, right? Because the government, and you can go into this a little bit more, but I'll say generally, if you make $5,000 a month going to work, and then you make $3,000 a month in rental income to the government, you make $8,000 a month. They don't care about your primary mortgage payment. They don't take into the actual mortgage payment either. They just take into payment, you have the interest that you can write off on the investment property. But they total all that together as income. So we have to think about what we make before and after rental income to make sure that as an investor, we're netting out the most amount of money and giving the government, hopefully, the least amount possible with what we're doing here. So, uh, we were talking off air and you mentioned about a client who had missed the largest business expense that you have with any type of rental income being the interest on your mortgage. What would be some other things that you think are highly missed or that people overlook when they're thinking about expenses or the expenses they should be thinking about tracking?
Well, that was an unusual case, to be sure. I think most people remember to claim the mortgage interest. The other Frequently, large deductions are property tax and maintenance and repairs. But some of the things that are missed are that depreciation or CCA that I mentioned earlier. And another one, often when you arrange a loan for a rental property, they charge you fees on top of the interest. And those fees are actually something you can write off over 5 years or less, depending on the length of the mortgage, etc. And that's something that people often miss. And these things can certainly add up and make all the difference to your bottom line because, as you said, as a taxpayer, you have the right to arrange your affairs to pay the least tax possible. That was actually stated in a court case by the judge. So that's the overall philosophy. That's what I try to do with my clients is make sure they pay the least possible without, getting too aggressive with the deductions. But that said, it's important to keep track of your expenses, to keep all your receipts. People will sometimes say, well, I don't know where the receipts are, but I have my bank statement for all the debit card transactions. I have my credit card statement for all the credit card paid expenses. But CRA has explicitly said they will not accept that. You need to have the actual receipts along with the statements. Now, push comes to shove, you can, with a good representation, you can get past that, but why set yourself up for grief? Just keep the receipts and keep them organized.
My mother's a bookkeeper, and she helps with all of our books, and that's something that I hear all the time. We need to keep all the things. She marks them all off. She tracks everything. She prints and manages, and it's perfect the way that she does everything still. And then we track it all. But there are softwares now as well to upload receipts that people can get rather than if they don't want to just keep that physical receipt. There are ways to do it, you know. The good old shoebox method is probably not the best one, but still there
No.
are people that use that. Try to keep it organized. I think the best way to do it would be to keep your physical receipts in monthly folders or monthly envelopes, and then track that into a spreadsheet as well, so you have something digital, but also with those backups, and the digital is obviously easier to share with your professional.
Yeah, that's a good point because it's not as common as it used to be, but you used to have a lot of receipts that were printed in what they called thermal paper. And the issue with that is that fades very quickly, like matter of weeks. And you're supposed to keep your receipts basically 7 years. And certainly CRA typically works in a 3-year window. So if you go to pull out receipts from 2.5 years ago and find all you have are blank sheets of paper, that doesn't do you any good. So therefore, having them organized in the monthly folders, as you said, along with an electronic copy, that is certainly going to help you tremendously down the road. I know these things take a little bit more time to organize from the start, but they save you hours and hours of frustration later on if it ever comes to a question of you being able to produce a particular receipt or a set of receipts.
I think that's like a lot of things, right? The tedious stuff that takes time will do us so much more benefit later on if we just do the tedious stuff as it comes. I get in trouble all the time for my wife for the little things that I let pile up, where if I just did them, it would be easier. But that is a conversation for another episode. We were chatting
Definitely.
about personal versus corp earlier. We got
Right.
into it a little bit. I don't know if there's more that we can dive into just to kind of separate the two to help people out there understand the difference, what they do as
Sure.
advantages, disadvantages, and I'll let you run with that.
Yeah, to get into it a little bit more, people ask all the time, should I incorporate? And to me, incorporation comes down to two main categories. One, legal liability concerns, like we talked about, and two, control over the nature and timing of your income. So, legal liability, it covers things such as a slip and fall. Uh, Someone comes to visit your tenant, or your tenants themselves actually can slip and fall, say on the side stairs during wintertime, they can sue you even though they're the ones living there. And people will have to evaluate how big a risk that is. I would certainly say if you own a commercial property, like, say, a restaurant, and you're renting that to the restaurateur, there's not even a decision to be made. It's automatically get a corporation, because a restaurant's hoping to have what, hundreds of customers every day coming in and out. And especially if you're in Canada, chances are you're going to get snow and ice, slip and fall. They sue the restaurant, which means they sue you. You have to have a corporation. Now, in terms of controlling the nature and timing, what do I mean by that? If you're taking in rental income personally, there's no planning to be done. There's no characterization decisions. It's going to be rental income on your personal tax return in the year earned. That's it. Now, there's no other way to deal with it. However, if it's corporate income, you can choose to pay out the income in terms of a salary to yourself, a bonus at the year end. You can pay it out as a dividend. You can pay out half of it now, half of it next year. You can pay out none of it now and all of it next year. You have the flexibility to control the nature and timing. And there is differences on how dividends and salary, etc., are taxed, which can influence how you want to be paid that particular year. And maybe this year you sold one of your properties, so you can have a big capital gain to pay tax on. In that case, you may decide, I don't want to take any salary at all this year. If you're in a corporation setup, you can choose to do that. If you're not incorporated, there's no choice. It's all coming in the same year regardless. So those are some of the considerations. The other thing to look at is the tax rate. In Ontario, the personal tax rates run from a little over 20% to over 53.5%, with that highest level being reserved for income in excess of $248,000. When you have rental income coming into your personal tax return, it just gets added on top of wherever your other income is. Whereas if you're incorporated, there's no sliding scale, graduated rates type of thing. You hit 50% plus from $1 of income. And that can give you, as much as a 30% additional taxes paid, corporate versus personal. However, and again, this is where having a professional advisor give you their input, perhaps you have a spouse that has no source of income and they can keep the books for your corporation and they can do the property management. Well, now you can pay that spouse and reduce the tax from 50% in the corporation to probably 20% in their hands. And you just save yourself that 30% additional tax, and at the same time enjoy the protection of the legal liability shield of the corporation.
Again, it all comes down to personal situations and how you can definitely do different things. Just with what you were saying there, I have a colleague, her and her husband, they own, I'm going to say, somewhere around 10 properties. I don't know the exact number, but we were talking about helping her manage them, right? We said, hey, we can take them on our side, blah, blah, blah. And she's like, you know what? My husband's retired. He's got the time to do it, and he likes doing it and to be involved. And I just said flat out, I was like, well, then bar for not, to have us or not, if your husband's going to do it and you guys are happy with that and that's something that you're enjoying, he should start up his own, 1, 2, 3 property management company. And you should be paying his property management company to be doing this rather than just keeping it as income that your family is making and spending less, right? A lot of times, in many different ways, I have this conversation. People are caught up on two different numbers, and that's how much they're about to spend or how much they have the possibility of saving. And those two numbers are great, right? We want to look at that. But the number that really matters always is, what are we netting? What are we walking away with? What are we finishing up with? Because I can tell you sometimes it's better not to save money than times it's better to spend more, right? Depending on what we're going to walk away with a net. And that's why your specific situation matters. And you want to be talking to professionals about your specific situation. Um,
Yeah, and I would also add to that that property management is something that you should factor in to your decision to buy a property in the first place. Even if you plan to manage it yourself, if the only way the deal works is if you self-manage, it's not a good deal. And at some point, you're going to get sick of dealing with the tenants yourself because you have 10 properties, you're going to have at least one tenant that's calling you, every 2 weeks because of this or that issue. And do you need the headaches? Yes, you can do things yourself, but is it a good use of your time? Uh, Not always. So I had a dishwasher put in my home, and I watched the guy do it with his daughter, and they took about 45 minutes, and they're running upstairs, downstairs, pulling this out, turning that on, turning that off. I said, I could have done it, but it would have taken me the whole day, and I probably would have said a few bad words along the way because it's not something I do every day. And instead, I did 45 minutes of consulting work, and that paid the bill for the installers to do their thing. So leaving the things to professionals, it certainly takes away all the hassle, and it does free up your time. So if you're putting it to productive use, I'd say you're saving money by spending money.
I agree with you there. I have that conversation with my wife about a few different things where we can be better using our time and hiring professionals to do different things. My dad always said that to me. He goes, do what you do and hire professionals to do what they do. It
Mm.
builds out your network and everything as well. This has been a little great conversation. I have a couple of topics that I want to just wrap up with. One, your book. Let's let you to plug that a little bit and talk what it's about, how it can help our new investors that are thinking about getting in the market, because now is a great buying time with everything that's going on. Pricing as where it is, and again, I've said this before. My favorite Warren Buffett saying is, "When others are greedy, you should be fearful. And when others are fearful, you should be greedy." And right now, everybody is fearful of the unknown, as we're saying. But the one thing that is known is that everybody needs a roof over their head. So that is my pitch for now. Is a good time to buy. But let's look at this book. Let's give you a little rundown about what it is and how it can help our Canadian investors here.
Yeah, sure. The title is A to Zen Real Estate, Peace of Mind Strategies for Canadian Investors. And A is spelled the Canadian way, EH. And it's directed towards the beginner investor primarily. While there is a section on taxes and another section on structuring, I didn't want that to be the whole book because then, I'm writing a textbook for, for accountants. I wanted it to cover the areas that most beginner investors need to know about. So it talks about the importance of mindset, of building a power team, of looking at different types of investment. It's not just you buy a condo, you buy a single family home. You can buy multifamily. You can look at building accessory dwelling units or ADUs as they're called in your backyard. And it's not just for people to live in. You can also create a workshop environment for someone that, works with their hands, let's say, and needs a space to work. People also are building them as a satellite office because the house is full of screaming kids and it's not the best business environment. So it covers many, many areas beyond just the taxes and structuring that the whole idea is to give the beginner investor the courage essentially to step forward and take action because you don't want to rush in with no information and just blindly follow your instinct and hope that it works out. And the worst thing can happen is it does work out the first time because you think, oh, this is easy. I don't need to know what I'm doing. And then you get stuck with, the tenant from hell who doesn't pay you for a year and a half while you're fighting to get an appointment with the landlord tenant board and get them evicted. versus a person who takes all the trainings, buys all the books, listens to all the videos, but never takes action. So you need some information, you need proper guidance from advisors and coaches, but then you need to take action, or the whole thing is meaningless.
The hardest thing to do is to start, right? That is very, very, very true. Uh,
Yeah, when I was young and stupid and jogging every day, the hardest step I took was the one out the door.
right? And then it just
So
rolled after that once you get going.
once you get going, you're going.
They say that about getting dressed and working from home, right? That it's better just to get dressed and start your day that way if you're going to work from home versus going to down in your pajamas to work. So I think that's great. All for the book. If you're interested, Michael's information will have popped up a few times. I'm sure there's going to be a link somewhere that'll get you to whatever you need. If not, reach out to us and we'll connect you with them. But lastly, before we go, I'm going to put you on the spot here, Michael. We'll give you his number one do, you must do this, and your number one don't do this. If you were to give out those two extreme pieces of advice to somebody getting started on the accounting side, what would they be?
The must do would be to expose yourself to a variety of different ways of investing in real estate, to find one that truly resonates with you, and then work that one until you've got it humming along before you jump to something else. There are many different ways. We never even mentioned it, but wholesaling, for instance, is probably the most affordable way to start your real estate career, because under that scenario, you're flipping paper. You're finding a house at a good price, you're getting it under contract, and then you're assigning that contract to the buyer who will actually close on the property. So in this scenario, you never take title, you never possess the house, you don't need a corporation because you're never the owner, and you only need a few $1,000s to put down a deposit kind of thing. And yet you can make 5, 10, up to 30,000 or more if you're in a high priced environment like Toronto or Vancouver. And some people, they make a career out of doing that. Other people would never do that. So don't just go with the first person you talk to about real estate, what they're doing. Find out what is possible and then run that down for yourself. And in my book, I cover a whole bunch of different options of how you can get started.
I like what you were saying though with figuring out how and what makes sense and resonates to you. Because, like you said, there are many, many, many different ways and different strategies to invest in real estate. They can all be very profitable if done and harnessed the right way and understand different things. So, having guidance to do what you want to do, like if you're going to flip houses, working with somebody that wholesales is probably not the best way for you to learn how to flip houses successfully. So building that team, like we talked about in many other episodes, and even at the beginning of this one, is very important.
As far as a must not do is you must not treat this as a hobby. It's a real estate business. So treat it as a business. Take it seriously. I mean, you can have fun doing it, but you need to take it seriously. You need to keep proper records. You need to get proper advice on what works best for your specific scenario. And you need to dedicate time to it. Now, time commitment will vary with your situation and what you're looking to do, but everything requires some effort, and you need to build that into your schedule and not just say, "Oh, I'll get to that when I think of it," kind of thing, because you're not going to be a successful investor. Treat it as a business.
Love it. That's another one that we say all the time. This is a business, and you should treat it as such. With different things like rent increases and stuff like that, and tracking everything. Where people think,
Yeah, that's one where people get in trouble because it's, "Oh, he's a good guy," or "She's a single mom," and I no, no. What you do is you crank that sucker up as high as it'll go, and if you want to help people out, you take some of your profits and donate them. to your favorite charity, or maybe you know a family, just give it to them directly that could use the help. But you run it as a business. It's not a charity. You're not going to cut the rent in half because some student can only afford half. No, you get someone in who can pay the full freight, because the bank is not going to give you that consideration. Oh, you're renting to a student? Oh, cut your mortgage payments in half. We're good with that.
Oh,
The next time that happens will be the first time that happens, which is to say, it will never happen.
agreed.
So you got your costs, insurance goes up. Certainly, if it's a condo, your condo fees never go down, they go up every year. I say that because I own a condo, so I know that quite well. And you need to cover your costs. Again, it's a business. You're not doing this just to uh, help someone out. And all that said, I just had a presentation last night where they said by 2030, we'll need an additional 5.8 million homes. And we're only talking 5 years now. And we're right on track to build about half of those, which means there's going to be a severe housing shortage. And what's that going to do to rents? They're going to go up.
That is going to happen. We were talking about it just the other day with one of the builders that I work with. They showed a demographic to me that was how many units are units. I mean, houses, semi-detached townhouses, condo units, whatever. How many new housing dwellings, let's say, have been bought and sold or bought and built since 2018, all the way to that are bought to be built in 2029. And the province of Ontario's goal is 32,000 new dwellings each year. Since I've been doing this since 2012, we've never come close to that, except in 23, we built 28, I think. 24, we were also in that range of 29 or something like that. I don't have all the numbers exactly off my head. Then we went to like 40 something this year in 2025 because of all the demand. Next year, 2026, we're back to somewhere around 20, 25,000 again. And then it slowly peters down. And in 28 and 29, we're less than 1,500 units in each year bought currently to be built, which tells you how far behind we will be and how much pricing and everything is going to change when that comes back around. The good old roller coaster of the ups and downs, right? To supply and demand, but it is going to come back.
Absolutely.
You know, the numbers are there, right? And that's the thing. But people needing roofs over their heads, they just built too many one bedrooms and one bedrooms plus den for the demand currently, but it's coming back. We'll sign off with this last little piece of thing that an RBC buddy of mine, his boss, basically was talking to us the other day. Same guy that told us back when we started that price per square foot was going to get up over $1,000 back when they were at $200 or so, and we told him he was crazy. That was nuts. Now we know that we got north of that, right? We're back down now to about 800, 8.5 per square foot to purchase. But he says that we're going to get north of $2,000 a square foot in before 2030. So here we go. So if you're going to buy a condo, you know, and you're worried, now could be the right time to do so if you're planning to hold it. But do beware, those maintenance fees will always go up. So don't get one with a pool or a concierge because manpower and pools are always going up. And
Now you tell me, because I have both those in my condo.
those are the big ones, right? Having pool maintenance and having a 24-hour concierge, although that provides security and that's something that people do appreciate. So, but the pool, if you're not going to use it, because most people in the condo don't use their pool. Um, you know, anyways, it's just a known fact.
I used it regularly once a year,
Yeah, there you go. There you go. And that's the biggest
literally
cost.
once a year.
That's the biggest cost in your maintenance fees. Anyways, folks, that was a great little chat there. I hope you guys enjoyed that as much as I did with Michael. If you want to reach out to him about getting started with your accounting or maybe helping with your current real estate investment properties accounting, I'm sure he'd love to talk to you and help guide, advise, and consult you into saving hopefully some more money in your pocket. But all of his information is below. Reach out to him, connect with us. Thanks for listening. Share this with a friend of yours, and we'll talk to you soon. Bye for now.
Please remember, while we are professionals, this podcast is for informational and entertainment purposes only. The advice shared may not apply to your unique situation. Always seek personalized advice from a qualified professional before making any investment decisions.
Hey everybody, thanks so much for joining us this week. I hope you enjoyed the episode. If you're finding it informative and useful, make sure to like, subscribe, share with a friend so that we can keep getting the information out there to Ontario landlords, and keep on joining us. We'll see you next time.